Welcome back. Market reaction to some big news of last week. That was the Moody's decision to downgrade U.S. debt, leaving it with no AAA rating among any of the major rating agencies, was somewhat muted. Let's talk to an expert about that development. We're joined now by Noelle Corum in Lexington, Kentucky. She's Senior Portfolio Manager at Agile Investment Management. Noelle, thanks a lot for joining us. A lot has been made since the downgrade that markets didn't really react at all. Certainly equity markets were almost unaffected by the news and were unaffected by previous downgrades of U.S. debt as well. Is that what you would expect as a fixed income expert?
I think this time it's a little bit different. So we take a step back and think, okay, why did Moody's downgrade the U.S.? It's because of the debt picture is growing, right? And that's because of fiscal spending. That's because of the rising spending overall. It's because of tax cuts. And all of that are surrounded by decisions that, are the budget's being delayed, right? So that draws a concern here for Moody's, and they have to respond to that. But like we saw with the S&P 14 years ago, you're right. We still remain one of the best economies to pick up yield relative to the rest of the world. So what is the economy doing? What are we thinking, and how are we thinking about it? Well, the U.S. economy is still relatively resilient, and that's what investors have to bring it back to. Does it make sense to still be here? Yes, volatility is picking up a little bit, but what are we thinking about in terms of the hard data is really what matters at the end of the day.
One view is that elevated levels of fiscal spending are stock market positive because they put elevated levels of fiscal spending, put a lot of liquidity into economies.
Right. So when we think about the fixed income market, the rates market, if you watch the rates market today, right, the curve is steeper. So that's saying that investors are demanding more out of the U.S., especially as you get into the longer term premium. So as you get out the curve and demand more out into 10s and 30 years, the yields are rising. And that's because borrowers or lenders are demanding more from the U.S. to be compensated for that rising debt level.
What about new issuances of U.S. debt? Will this require the U.S. to sell future issues of debt with higher interest payments?
Yeah, so we think the fiscal package and the tax cuts likely going to put some pressure on the long end of the curve and increase term premium over time. We do think that demand for U.S. debt overall will not truly go anywhere, and that will kind of put the pressure on the downside to how far rates can really go up. Overall, we still remain relatively positive on the economy. We do think the rates market here can be a little bit tricky, and we look for volatility, especially in that longer part of the curve.
Do you recommend diversifying away from U.S. fixed income?
Yeah, absolutely. I think that is part of this broader theme, right? As we see trade wars pick up and kind of concern and volatility in credit markets, it makes sense for investors to start to look elsewhere. So that's what we're doing at Agile. If you own a bond fund, you want to look globally. You want to look for those funds that are starting to look globally and diversify out of the U.S. because Europe, for example, very large fiscal package launch. We think there's going to be more out of Canada and even Asia, and that will start to support growth, which ultimately will start to support fixed income markets and potentially equities, although I'm not an equity expert.
To what degree are you exiting U.S. fixed income?
So we still like the U.S. more broadly, but we think it's going to be more of a clip the coupon play. We do think rates could bring some more volatility, so we recommend kind of staying in that shorter end of the rates curve, but still like to clip the coupon in the IG and high yield. You're getting like 5.5%, 7.5% there. So it makes sense relative to the rest of the world, but it's going to be at a higher volatility. So look to clip the coupon also in Europe, Asia, other markets at a less volatility. And over time, we think that'll provide more stability in your returns overall.
Noelle, thank you very much. Noelle Corum, Senior Portfolio Manager at Agile Investment Management. She joined us from Lexington, Kentucky.